Welcome back, everyone, to Not Your Advisor, an NYU grad on Thursday, March 28th. I have a lot on my mind today. I guess with the markets being so timid and light, I did a ton of reading today. But today is going to be a special podcast. Friday is quote unquote Good Friday or Holy Friday for Christians and Catholics. In general, and I'm going to rant a little today. I don't have too many individual stock charts to go over, but I do want to mention one thing real quick. I am going to share premium content today with both premium and free subscribers. It will be available for 7 days for free subscribers, after which it will go behind a paywall, only accessible to paying premium members. The reason I'm doing this is I feel like in one case I've worked really hard, not only on the Substack, the posts, but this one particularly, I don't see it too often out in the marketplace, and I feel as a public service, I owe it for my own conscience to share it with the world. However, I want to value the premium members who are paying. So I'm only going to make this available for free for 7 days. With that said, a couple bit of housekeeping. And this is not an April Fool's prank. Prices will be going up on Monday. The annual membership will go to $260 per year from $180. So that will basically cost 70 cents per day to be an annual premium member. I honestly don't think that's a lot, but I also know that there are many subscriptions, whether it be entertainment, news, or financial, that are competing for your dollars. However, I still believe I am underpriced for the work that I am doing and the quality of content that I'm putting out. If you did not want to make an annual commitment, the price will be $25 per month, which nets out to 82 cents per day. I am slowly trying to get to where I feel there's a value exchange. Even at these prices, I don't feel there's a good value exchange for me. But at the same time, I'm growing fast on Substack, and I want to be cognizant of those who are new to the Substack or new to just Substack in general, because there's a ton of folks that are finding me through other sources like Bill Cara, like Tim Knight and Slope of Hope, or just through search engines or X. So I want to keep the my Substack accessible to those who are new, who may not even follow financial Substacks, and let alone pay for them, who are more of a novice trader / investor. So new pricing will take into effect on Monday. However, there is a 20% discount on the annual membership on the current price of $180 per year, which will basically, the discount will get you to $144 for the year. Obviously, you can't expense it for this tax season, but for 2024, you can as an educational write-off. So that's just a bit of housekeeping. Tomorrow's a big holiday, and I actually wanted to share a poll. You'll find it on the show notes. But just a fun little poll here. Will the Bears be crucified and flogged by Powell? You can either say yes, given a pass, or just here for responses if you're too shy. But on Good Friday or Holy Friday, we do have a slew of data coming out, despite the fact that the cash session is closed. We have the PCE numbers at 8:30 and Jerome Powell at like 11:30 Eastern. I have no idea why he's speaking on such a quote-unquote holy day where the market is closed. It'll be very, very interesting to see. Last bit of housekeeping item. I haven't gotten any emails yet, but this week I did get a few asking the delineation between premium and free. Not only are posts delineated between free and premium, but also the podcast duration is different. Typically on a podcast, I'll say like in the 10 to 15 minute marker, free members, thanks. I'll see you after the next session. Premium members, please stay on, right? That's usually where the content gets cut off for free, and the premium members stay on for more content. So you want to make sure if you're a paying member of my Substack, you're getting the full podcast and all of the content. So I will try to make it a habit of posting how long the free version in minutes and how long the premium version is on the show notes, so you know you got the right one. But you can also add private podcast RSS feeds into many popular podcast platforms like Google, like Apple Podcasts. So you can just listen to the premium version right there. The only major platform that does not allow this is Spotify. But that's about it for the housekeeping side of things. So let's get on to the content. On Thursday, March 28th, we had 1,442 new highs versus only 89 new lows. 62% of stocks were advancing versus 34% declining. 28% were below its 50-day moving average, and 29% below its 200-day moving average. Now, if you follow the podcast, you'll know we've been hovering at like 34% below the 50-day and 31% below the 200-day. So this is an expansion of new highs and expansion of stocks above the 50, above the 200, which is all bullish. But today is the last trading day of the month and the quarter. Now, I don't have proof, but there is a thing called painting the tape. At the end of the month, especially at the end of the quarter, statements have to be digitally prepared and mailed out to clients on Wall Street. And historically, you'll find end of month, end of quarters more bullish than bearish. With very low volume and volatility today, it was fairly easy for the computer trading algorithms to just paint the tape however you'd like. And I believe some of that was going on today. But I digress. Let's go through my rapid fire of what was strong. These are all percents, okay? I don't want to say percent 25 times. So these are all percents. Restoration Hardware, 17.26%. VinFast Auto, 5.07%. Kinross Gold, 4.25%. These are all positive or strong. UVIX, up 3.86%. That is bullish volatility. Pan American Silver, up 3.43%. IBIT, up 3.42%. FBTC up 3.36, BTCO up 3.38, BRRR up 3.34, ARKB up 3.32. This is all Bitcoin related ETFs. Boyle UNG finally catching a bid, up 3.29. This is natural gas. Coinbase up 3.28. Bitfarms up 3.24. BTG up 3.15. UVXY, another VIX bullish ETF, up 3.10. Beezer Homes up 2.89. Paysafe up 2.87. Barrick Gold, ticker symbol gold, 2.65. Hovanian, K Hovanian Home Builders up 2.53. Marathon Digital 2.31. GDXJ 2.22. Pulte Homes Home Builder 2.21. Dell 2.18. GDX 2.13. VIX 2.11. Lennar 2.07. And crude oil 2.03. What was weak today before Good Friday? Reddit down 14.6%. I don't know how people are trading Reddit. That is not trading. That's not investing. It's gambling. MicroStrategy down 11.18. Donald Trump's media, Trump Social, DJT, down 6.43. And I'm just sharing that more because I'm following it out of curiosity and entertainment. I would never, ever recommend trading DJT or Reddit. Kura Sushi down 4.02. New York Community Bank down 3.59. Zillow down 3.53. Biddy, BITI, down 3.15. That's bearish Bitcoin. Clavio down 3.01. Natural gas down 2.79. How is natural gas down 2.79 and Boyle and UNG up? But I know it was flipped the other way. The other few sessions, like natural gas was up, but Boyle was down. So I don't really know what's going on there. Carvana down 2.66 and Tesla down 2.25. I'm going to still go through the motions, even though this is going to be available to free members, but for 7 days. But this is where I typically will say for free members, keep watching the Magnificent Seven, keep watching NVIDIA and the semiconductors, keep watching the 10-year yield and yield inversions and I would say, I don't even know what you call it. So yield inversions, but then you also have reinversions that signal the actual recession. But thank you for joining, and premium members, as well as free members for 7 days, please stay on. So I don't have the typical 30 to 40 setups today. I've covered those. Premium members have the links to all of those charts and tickers. What I want to cover today is the SPY VIX ratio. And you'll know I always start from the forest, then work myself to the trees. And this is something I probably learned from Bill Cara, to really focus on the interrelationships of different asset classes, and then within the same asset class, different groups of sectors and how they relate. One example is like currency pairs, right? You can't look at the US dollar in a vacuum. You have to look at the US dollar in contrast to gold versus the yen versus the British pound, etc. And I want to focus really today on the forest, not the trees. And as you know, I follow breath pretty religiously. That's why I start each show with breath. Not because it tells me a story every day. It doesn't. A lot of times it's just repetitive minutia. But it's very valuable to me because any idiot can look at CNBC and see, oh, the Dow was up 500 points, or the Dow was down 200 points, or whatever. S&P was up, blah, 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 blah. But when you take a look at breadth, it'll show when divergences start. And you can, if you follow my podcast every day, you'll get a sense of this, and you'll start to pick this up by yourself. But another indicator that I look at for the forest, for longer term trend changes, is the SPY S&P 500 SPY VIX ratio chart. So if you're not familiar with ratio charts, it's like the US dollar yen, right? Or the US dollar British pound if you go to London. And you get a sense of where the price of one thing is in relation to another. So the SPY VIX ratio chart shows the S&P 500 in relation to volatility. And the chart that I track goes back to 1992. What I like about this is that it gives you a macro forest view of the dot-com bubble and bust, the housing great financial crisis bubble and bust, and what we're in now, which is the everything boom and bust potentially. You'll notice on this chart in the show notes that there is a green trend line above. And we've only kissed this trend line 3 times in its history. Very conveniently, the first time was during the dot-com bust, then the housing great financial bust, and back like in 20, I forget what date this is, 2017 was third kiss. We're approaching the fourth. We haven't gotten there yet. And maybe this time is different. Maybe AI and NVIDIA and the AI boom will, excuse my use of language here, or trump. Maybe this time AI will trump this trend line. And we'll just go flying past that fourth kiss of this trend line. But if history serves me well, I would predict that we're going to get close to that fourth kiss. We might exceed it a little bit because of so much of the printing and the programs, but we're not going to exceed it by much. And I suspect once we kiss that fourth trend line, we will make a march over the course of 20 to 36 months all the way back down to 25. In order to keep in mind now, look at the chart. We're right at like 400 on this chart. We would need to get to about 440 to 450 to kiss it the fourth time. So from 450, I suspect we will march down on the SPY VIX all the way to 25 or below. In order for that to happen, there are 2 ways, or there's 3 combinations. One way is if the VIX doesn't move, it will just, VIX stays at $12. For us to get to 25 on this SPY VIX ratio, the S&P would have to crash. The second way is if the S&P never moved and it just stayed where it's at today, the volatility index would have to skyrocket. Or the third way is a combination of both. The S&P would have to go down and volatility would have to rise at the same time. That is most likely what's going to happen. So let's review this chart and let's deep dive. The first kiss, from peak to trough, from kissing the trend line to the low of the SPY VIX ratio chart, happened between August 24th of 2000 to July 29th of 2002. 23 months. Let me just take a sip of this wine in celebration or commemoration of Good Friday. So the dot-com boom and bust, the SPY VIX ratio, August 24th of 2000 to July 29th of 2002, was 23 months. Coincidentally, the housing boom and great financial crisis, that second kiss of this trend line, It started at December 15th, 2006, and to trough was November 20th, 2008. Ironically, coincidentally, 23 months, same exact duration as the first one. And now the everything bubble, which was interrupted by the COVID pandemic impulse. And what I mean by impulse is a crash and then a boom. We're in it now. But for chart purposes, it lasted for the SPY VIX ratio chart. December 27th, 2017 was the kiss, the third kiss, and it lasted 27 months to March 12th, 2020. The majority of the fall was post-COVID, but the SPY VIX ratio never got to 25. We got close. We got to 28.86. So where are we today? If you take a look at the close-up magnified chart of the SPY VIX ratio, we're at 410.68. We're getting very, very close to the fourth kiss of this trend line. Will we exceed it? Maybe. Will we fall short? We can fall short right now because the first kiss was a peck. It wasn't a smooch. But we're getting very, very close. So how did the S&P, forget the volatility index, how did the S&P perform in those same precise dates that I mentioned from the kiss of the trend line to the trough? For the first kiss, from August 24th of 2000 to July 29th, 2002, we were down 47% on the S&P 500. For the second kiss, from December 15th, 2006 to November 20th, 2008, we were down on the S&P 500 51%. And for the third kiss, from like December 2017 to March of 2020, we're down 26%. Now, I want to make note something unique about the third kiss. Majority of that happened post-COVID within like 2.5 months before they enacted all of the printing and the programs and stimulus going into the lockdowns. I believe that third kiss is not over. While on this chart, I am deeming it as a fourth kiss of that trend line, it's really the same one. I believe that third kiss should have probably went down even more than the second one. But incredible stimulus, fiscal spending, no mortgage late fees, no, evictions, no student loans, employment programs where, like, if you can prove your business has X amount of employees, you're going to get X amount of dollars per employee. All of these programs, helicopter money, paused this crash. But we're just kicking the can down the road. And the fact that even despite all of this, we're in the same spot. Consumer debt, private debt has unabatedly exploded. It doesn't seem like we've learned anything from this. If you take a look at the global numbers of debt to GDP, we're at record highs. If you take a look at domestic debt to GDP. We're near record highs. It's come off of the COVID highs, but we're still near lifetime highs or generational or whatever, historical highs. If you take a look at M1 or M2 money supply, we're near record highs. So we're very close here. I can't time it, right? Like, I'm not a divine entity here. But we're so close to this trend line. I would suspect maybe Monday morning, maybe Jerome Powell gets on TV tomorrow on Good Friday, and he was dovish last week. Maybe he'll be super dovish this week. And on Monday, we go up Dow 1000, S&P 400, NASDAQ up 800 points, NVIDIA to $1,200. That's all it would take for us to get to that fourth kiss. Or maybe we fall short. Maybe we're already there. But we're very close to this turn. And the reason I bring this up is, if you're 21 years old or 30 years old, maybe it won't matter as much, because as you can see, the last 3 times, the peak to trough activity was anywhere from 23 months to, 30 something months. It's not the end of the world, right? Like, you'll survive. But for 12 to 15,000 people who are becoming 65-year-old per day in America, if they have a drawdown in their 401k and their trading account by 50, 60, 70%, and they're retiring now, what's going to happen? Do they have the 3 years to wait and hope? God forbid we go into World War III and those, in 23 months recovery time or 27 months recovery time becomes 60 months recovery time or 70 months recovery time or 8 years recovery time. Do they have the time to recover all of their life's work? I don't know. So, look, I'm not your financial advisor or CPA or financial planner. But right now is a time to be very risk adverse, not to chase the hot thing, NVIDIA, SMCI, Reddit's IPO, or DJT, AMC type meme names. You really should be talking to your financial planner about hedging your risk. If you have the wherewithal and inclination to learn and manage your own wealth, that's great too. You don't have to follow me, although I would recommend it. But there are many good resources out there. There are many great books out there, like Bill Cabra. He has a new book for Maverick Investing Handbook. And it's going to focus mostly in the Dow 30 names. Not all the Dow 30, but majority of the Dow 30 names, the high quality ones. You're not going to lose your shirt investing in those names. But take a look at these charts. I'm not making this crap up. Right? Like, when my family members, I know 3 who've lost their job, but 2 are asking me if they should just not go back to work and day trade. As if it's that easy. As if, they've been working like 15 to 18 years. They're in their mid-30s. Like, this well of wealth, this free money of day trading was always there while they were working and slaving away at, 8 to 6 job. And now that they can't find another job, I'm just going to day trade because it's so easy. Everyone's doing it. Like, that is what they're asking me. And that happens at the end of the bull market, not the beginning. It happens when there's a lot of froth. So with that, and I don't want to end in a somber note, but this is real talk. This is what's really going on. But I would love to know your feedback. Am I crazy? Leave a comment on your own journey, your own opinions. But that's all I have for today on March 28th. Just as a reminder, this will be free for everyone for 7 days. But this is the type of content that I typically share only with my premium members. But because of the price increase, because of Good Friday and Easter, I felt like this was an important message and content to share with the world at no cost. So if anything, if you decide you don't want to upgrade to premium, at least share it with someone you care about or someone you think that might benefit from this data. So just forward it, post it on X, reshare it on Substack. I would appreciate it. With that, I hope you all have a safe holiday weekend if you celebrate. And I will see you after the Monday session after the break. All right, have a great weekend.